Guys, here we go, your final assignment. So our COVID-19 Unit 4, we're going to be looking at the last couple of slides of the PowerPoint to really understand some of the different economic policies and ideas that we can be learning from COVID-19. So let's go take a look at this. Here we have our assignment. Okay, we have slides 28 to 32 in the PowerPoint. We're back in our core book. This time we're in Unit 14.6. We're going to learn about fiscal policy, which is very important when understanding the stimulus package, unemployment, a lot of the current things that are happening right now in our corporate world. We have an article to read about COVID and the economy, and another one about New York Times and people flipping product during COVID-19. And then we have our workbook. So let's get all of these things up and ready. I have PDFs in case these links don't open. You can always download the PDF. And let's go get our workbook open. So here we are, pages 19 to 20. We're on COVID Unit 4. So here we're looking at something called composition effects. And before we jump into that, let's take a quick look at our PowerPoint. Okay, so we're going to go down to the last couple of pages here. We're starting on 28. So it's composition and scale effects. So we're going to be learning a little bit more about what that means. So if we look at this on the slides, we have a couple of statements. So the economic effects of COVID-19 can be partitioned into two categories, okay? So you have the composition effects, which refer to the collapse in demand for some goods and services, like we've already been seeing in many of the industries that have been closed down, especially in travel and restaurant services, concerts, okay? And this is happening. There's a collapse in demand for some goods and services, even as there's a surging demand for others, okay? So the collapsing demand, again, travel, lodging, meals, entertainment, and then the surging demand, health services, masks, ventilators, sanitizers, okay? So this is the composition effects. Scale effects are the collapse in an aggregate output, okay? So aggregate is an economic term, and it means all of it, okay? So a collapse in the total overall full output and employment, okay? So the fact that people are not working and not making stuff, that's a scale effect, okay? So we're looking at that total collapse where the overall output, we just had our GDP, a quarterly GDP announced in the United States, and it's down 5%, okay? So, and that's because some of the strength of January pulled it through, so it's not down the full 20% that people are expecting it's going to be next quarter. But for this quarter, the quarter that just ended, the 3 months. So a quarter is 3 months from January until March, January, February, March. So for those 3 months, our total GDP was down 5%. And that's in reference to our collapse in aggregate output and employment, right? People aren't working and they're not making stuff, okay? So we have a predicted contraction in the second quarter. Now remember, these slides were done in March. They predicted 14% JPM, okay, and GS, Goldman and Sachs, and this is JP Morgan. So JP Morgan said we're going to have a 14% decrease. Goldman and Sachs says 24%. And it looks like we're probably going to be hitting about a 20%. Okay, so they were sort of pretty good predicting that back in the end of March. The Treasury Secretary said that we would have an unemployment rate of 20% as being possible, and we've seen, yes, absolutely, indeed, it is very possible because that's pretty much what we're at right now. So even in the end of March, people were starting to look at what was going on and making economic forecasts, okay? And now, to be able to make these forecasts and understand or anticipate what's going to come up next, that's when the Fed can start thinking about, well, what are we going to be doing? What's the Treasury going to be doing? What's the government response to this going to be? Okay, so by using these economic indicators to think about what the effects of this epidemic can be, policymakers can start coming up with plans of how we're going to accommodate this, how are we going to get this to move away, how are we going to prevent it. I think prevention really wasn't something they were looking at, but at least how can we alleviate it or make it be less or for not as long, okay? So if we go a little bit more detail into the composition effects, okay, and then we're going to go into scale effects. So looking at composition effects, we have for goods and services in high demand, that there's incentives needed for more supply, right? So everybody wants, for example, face masks. So now cottage industries have sprung up making face masks, right? People are making face masks at their home, okay? And the incentive was to be able to get paid, right? To be able to earn some kind of income. But something else that came from this COVID-19 is this altruistic trend, which was not predicted and is sort of heartwarming. So a lot of people are doing things because they want to. They want to help out. They feel it's the right thing. They feel empathy for their fellow Americans or people around the world who are struggling, and they want to help. So there's two kinds of incentives. We have an incentive of empathy, and we have an incentive of economic gain. And that's really interesting to think about that. And it's really hard to measure or anticipate an empathy incentive. But it'd be interesting to study that. And then the idea is also the market will respond to some extent, right? So I just read an article today about Nike repurposing their shoe factories to make face shields for hospitals, right? So that's like the market responding. Amazon, for example, hired 100,000 more workers and they raised their pay, right? And a lot of people who are now working in the markets are being paid higher. Even though, according to economic theory, if you have very low unemployment, very high unemployment, you should have very low wages, right? Because workers become a dime a dozen. But these are different times. So our wages are higher. A lot of times they're state mandated higher because we're respecting the risk that our workers are putting themselves at in order to come to work. So a lot of workers are getting raised pay. And that's also an incentive. So sometimes it's government. Sometimes it's just the business itself wanting to set forward a good face. But a lot of times it's also incentive because people don't want to work. They're fearful, even though they need the money and they need the job. So that raised pay will kind of help give them that extra incentive to come into work and take on a position that might expose them to the virus. Okay, so I just gave you a lot of really different contexts and economic ways of thinking about things right there in those 3 bullet points. Okay, so moving on with this composition effects, we have some distilleries are converting their operations to produce disinfectants, right? So we've seen that as well. But market solutions are not adequate to both on both efficiency and equity grounds, right? Even though Nike is making the face masks, they're not really face mask makers, right? They're probably not doing as good of a job as someone whose entire production is dedicated always to making face masks, okay? And there's also equity, right? Who's getting the face masks? Who's getting the raised pay, right? So these market solutions are sort of patchwork solutions, right? They're not going to be a long-term piece, okay? But it's something that's able to happen right now, okay? And they're not perfect. That's what we're talking about here. Here's another piece. We have ventilation production, for example, relies on disrupted global supply chains, okay? So even though companies in the United States are making ventilators, they're relying on parts coming from China. Even face masks, there's a special filtration cloth that is only made in China. Okay, so as these global supply chains break down, for example, when the Chinese factories were closed, or when even USA factories have been closed and businesses aren't able to get all of the parts they need, it affects all the production of all kinds of goods and services, even ones that are in demand. So this creates a role now for the government. So here we are in macroeconomics, right? Looking at things from the big picture, the government view, okay? So now the government has a role where they can mandate or subsidize production. So the government can demand, hey, Nike, go make those face masks. They can demand, hey, Ford, go make those ventilators. Okay, and they can also subsidize. They can throw some money that way. They can say, okay, we know that you're going to have to pay extra for workers. Here's some extra money for that. Okay, so these were predictions made back in March. And we've seen that the government has taken on some of these roles. They haven't mandated production as they could in wartime, but they have more or less subsidized by offering low or no interest loans to small businesses that a lot of people think will turn over and just become grants, which means they don't have to get paid back. They've offered payroll protection for larger companies. So if companies can't meet their payroll, the government can come in and give them a short-term loan to be able to meet the payroll. Again, that might turn into a grant where it doesn't have to get paid back. So we have, this is sort of a subsidized approach, right, to production, at least to business, right? The government has stepped in and helped out. Here's a question: should affluent individuals be allowed to buy and store ventilators, right? Is that going to be fair for other people in the United States that might not have the ability to purchase them, or even hospitals that might need them? Is it fair to allow others to go and get them first just because they have the resources? And here's another question: should hoarding and profiteering be monitored and punished? So hoarding is like, everybody buying all the toilet paper and hand sanitizer, and those that weren't able to get to the store, didn't have as much income or means of transportation, or had a compromised immune system, they lucked out, right? They were not able to get access to those goods. And then profiteering, people buying those hand sanitizers and then flipping them, right? Buying them for $3, selling them for 7 or 20 or 50, right? And making money on that. Should that be monitored? Should that be punished? What do you think? All right, we're going to take a pause there and jump into our workbook. All right, so here the first thing, the composition effects. Okay, so we have this collapse in demand for some goods and services. And the automotive industry right now is in collapse. All right, we have a German consultancy firm called Roland Berger, and they produced 3 scenarios for the automotive sector in this article. Okay, and we're going to go look at the article a little bit more and understand what they're doing. And just so you know, a consultancy firm, these are people that are investment consultants. So people will hire Roland Berger to help determine where should they put their money, where should they invest in growth, where should they help other businesses. So they might work with governments, they might work with investment funds, they might work with investors themselves, but that's what Roland Berger does. Okay, so they're an expert in being able to predict and understand different industries. All right, let's go see what they say. Okay, so here's our article, right? Klaus Faust wrote this. He's the principal in their Dusseldorf office. And he said that COVID-19 has the potential to trigger a global economic crisis. Okay, this article came out in early March. All right, so think about where we are since then. And here he's just giving us an introduction. It's spread to more than 110 countries. And it's saying that we should currently expect to see a negative impact on all sectors of the economy. And kind of like what was already talked about in our slide, right? Bottlenecks in logistics, which is the supply chain breakdown, plant shutdowns and turndowns in business investment and consumer spending, which is exactly what happened. Okay, so they're assessing the disruption of global businesses, really looking at supply chains and industries. Okay, and they're looking at this globally because, again, we're not just working in an isolated world. One of my friend's daughters got in touch with me and wanted to know, how is COVID-19 different than the Great Depression? And that's one of the biggest differences, is that we are in this globalized world. Okay, we're much more interconnected than we were during the Great Depression. So here we have 3 scenarios. They developed 3 scenarios of what might happen from 2020 to 2021. So one would be a fast recovery. We get through this. We're already starting to flatline on some of our numbers. Let's say they just dive down by June, business as usual. We're great. That's a fast recovery. And then we have the medium recovery and we have a slow recovery. Okay. And we have this idea of a recession being triggered by it. So let's go see what happens. So let's say the first one is we have a severe blow to growth. Okay, with GDP dropping as much as 3.5 percentage points, and we've already seen, well, this is China, we've already seen in the US, our GDP has dropped 5 percentage points. Okay, so we're already going below a severe blow. And then they're talking about flare-ups, what happens if we have flare-ups, and then there's bankruptcies, and then there's all kinds of monetary policies and responses that might not really be seen until Q3, right? Because as this is still rolling out, we're not really sure what's coming up next. So they have a delayed cure scenario, right? A more moderate one. Okay, so the first one is boom, we're in and out, it's good. The second one, we have a delayed cure. Infections are going to slow down, but there's still going to be quarantine. We're going to have bottlenecks. That's kind of where we are right now. Okay. Okay, and their worst case scenario is the profound recession, where things don't start picking up until 2021. So this continues on into the fall, into the winter, and then finally in a year, we'll start seeing things moving forward. Okay, so we'll have that second wave is really going to knock us out. So those are the three scenarios. So profound recession, it's awful, right? Comes back in the fall, knocks us out. We never really got on our feet in the first place. Delayed cure is sort of what we're in right now, where new infections are slowing down, but we still have quarantines. We're kind of like sort of in between that and this one, which is fast recovery, which is saying that the quarantine lifted, production goes to normal, everybody's fine. We don't see that second dip. Okay. So Europe is the world's biggest trading bloc. Okay, could be hard hit. And they look at, what is this going to look like in Europe? Okay, and what would this look like in the United States? Okay, and since we're in the United States, let's see what they have to say. And of course, read the Europe one too. But here we have a strong focus on the domestic market, right? That's the US, and an orientation towards services. They're saying we might not be as badly affected as other places. Our North Atlantic supply chains and a drop in consumption, they're saying our GDP might drop 1.2%. We've already dropped 5%. Okay, so again, it's more extreme than they thought it was going to be. In their moderate scenarios, supply chains, that's their worst case scenario, worst case scenario. We see a strong impact on NAFTA. So we're already beyond kind of worst case. But in the moderate scenario they gave us for the United States, they thought supply chains would be interrupted in certain industries and stimulus will kind of get things going. It's an election year. They figured, we're going to get it together. And in best case scenario, there's no slowdown in growth. Domestic demand is stable and everything is business as usual. So a pretty rosy picture there, right? We're already way behind that. We're kind of more close to the picture they created for China, okay, than anything else. And I guess let's just look at what they said for Europe. So for Europe, they said that worst case scenarios, full containment wasn't achieved until 2021. So there's still outbreaks all over the place. Shortages in the healthcare system. The delayed cure is going to be supply chains from Asia to Europe being impacted. And then best case scenario is disruptions just occur in specific sectors. So we've already seen we're way beyond that, right? We're completely intertangled with ourselves. Europe, the US, and China, we're all in this together. All of our supply chains are much more integrated than I think these guys originally thought. And yeah. So let's go see. So even though we know that they painted a little rosier picture than what actually happened, let's go look at what they're talking about in the automotive industry. Because they're saying, well, yeah, we have this rosy picture or whatever, these three different pictures, and it's going to change country to country and also industry to industry. All right, so we already saw their country ideas were a little bit off. Let's see what they think about the industry. So they noted that the automotive industry already had slow growth rates in 2019. Okay, it was already off to sort of an awkward start. The gross value added could fall as much as 10 percentage points in 2020. Okay, in the worst case scenario, without a COVID-19 impact, with vehicle sales down 10%. So they already were predicting a slump in the automotive industry before any of this even happened. And now what they're saying is in the worst case scenario with COVID-19, it could get even worse. Wait, where are we? Gross in the worst case scenario. Okay. Without a COVID-19 impact. More than 10%, sales down more than 10%. Okay, so it looks like either way, they're looking at the value in the automotive industry was going to fall. Okay, with COVID, without COVID, they were predicting a pretty steep decline. In the moderate, they're seeing a significant decline due to the component shortages. And in the fast recovery, they see a slight drop in sales volumes, followed by a compensatory ramp up. So that's interesting, because with the compensatory ramp up, what they're talking about is the idea that people that would have purchased cars haven't purchased them yet. Okay, so there's a demand, there's an unmet demand in the automotive industry. So they're saying maybe in the fast recovery, that unmet demand might be able to filter in fast enough that it's going to have an impact, a positive impact on the industry. But they're also saying the supply chain is kind of screwing things up, especially, as we get close to the fourth quarter. So if we look at this in graphically, let's see what we're at. And this is what's in your workbook, okay? So here's the fast recovery, delayed cure, and profound recession. So fast recovery, they're saying this is what we're looking at, the regional impact. So they have China, US, and Europe. So who's going to be bigger impacted? Again, they keep thinking China's going to be the most impacted of everybody, then Europe, and they gave the US a pretty rosy picture, right? And my observations is we're kind of even, and maybe China's even a little better, but it's hard to tell because we don't always get complete information from China. But I don't see as big of a difference between Europe and the US. I see Europe being more negative than these guys are saying. But if we look at this, the red line is the impact of COVID-19, and the blue line is their forecast, okay? So here what we have is 2010 sales volume is below the initial forecast, okay? And then we have our ramp up to compensate for deficit. So here they're looking at 2019, we're already in a slump, right? And this is what they saw would have happened. We would have kind of gotten to zero and just maintained it. But now, because of COVID-19, this is best case scenario. We're in this slump, and here we are, we're in quarter two. He's saying sales are going to pick up. They're not yet, right? But quarter two ends in March, April, May, June, in June, okay? So maybe we'll see this in quarter three, who knows? But anyway, so their fast recovery said that by quarter two, sales are going to really skyrocket because we had this period of time where everything was repressed. And then they're going to level out to kind of where they would have been in the first place. And then by 2021, everyone's just going to be breathing such a huge sigh of relief that they're going to want to gas guzzle all over the place and buy tons of cars. The delayed curve, which is kind of where we are right now, is 2020, we're seeing a slump that's going to go all the way into quarter three, which I think makes sense. We're going to maintain our current slump. Quarter three puts us in September. Right? 6 months in. Yeah, 9 months in. So it's going to be September. And then in September, when everyone's back to school, back to college, everything's all open, we don't get that second round, things are just going to skyrocket, right? That pent-up demand is going to go through the roof. Everyone's going to grab the cars. The dealers are going to be giving away cars. It's just like craziness happening by that point. Our supply chains bounce up. Everything's working good again. And boom, we keep going, okay? And what we'll see is they predicted, you can't see it here, the dark gray is underneath here. So they predicted by the end of 2020, the car industry would normally get better anyway without COVID-19. And now what they're saying with the delayed cure, we'd be back on track, right? So it's all about that getting back on track, right? They predicted that we would go above that. There'd be a little bit of recovery in the automotive market. Right? The question is, and it would happen in the beginning of 2021, okay? In this case, with the delayed cure, we'll actually see that happen even sooner, right? But we've had that bigger slump. And then the profound recession, which is kind of what we're teetering back and forth on right now, because we might end up getting a second round in the fall. And what that's going to look like, according to them, is slump sales, and it's just going to get worse. Right? Worse, worse, worse. Everyone's quarantined. Nothing is really opening up. Every time we open up something, it closes back down again. It is a mess. It is now December. We're finally getting some relief. And boom, things are going to just explode, right? It's just going to be like the roaring 20s all over again. Everyone's going to go bonkers by the middle of 2021. So that's our worst case scenario. Okay. And then it'll settle back down again. Okay. So who knows where we're going to be, right? So it's interesting looking at that. Like, how do we predict this? If this is what's going to happen, right? Right now, the government's pumping all the money to in this part right here to help keep it not so deep, right? To help fill it up a little bit. So when we hit this point, when people can go out and businesses pick up, where you can just skyrocket up as fast as we can, right? And that's what the government's kind of counting on, this sort of like filling up, if you think like a catapult, right? They're just, cranking back that catapult, putting as much artillery as they possibly can in that big catapult pocket. So when the time comes, they can just go bing and let go of that catapult, and all that money will go flying into the economy. All that pent up demand, all that pent up savings are just going to go flying out there and just get everything up and running. Excellent. All right, let's go look and see what the workbook says. So here we have challenged by already weak growth rates in 2019, right? We just talked about this. So how is R&B, right? R&B is Roland Berger. How are they anticipating demand in the face of a fast recovery? That's right here. I just told you. Now you tell me. How are they anticipating demand, right? Here we are below demand. What's going to happen? How are they anticipating demand in the face of a profound recession? That's called disaster, right? We have another round of COVID hitting us late summer. We just can't get out from under this. Talk to me about it. And why, right? What's going on? I just told you. Which countries are most impacted in this model? Okay, that's looking at this data down here. Why? You tell me, read the article. I already kind of went over it with you. And that's it. Okay, so I'm going to stop here, and then I'll make another video talking about the next thing, okay, and our next article. Have fun.